we like to say is we're unlocking that freedom. Like Robert Kiyosaki on the right side of the quadrant, right? Getting on the business or investment side of things. It's like, how do we use tax flow in this situation using the Deferred Sales Trust to unlock what someone's really trying to accomplish, whether that be moving, closer to family, selling that big primary home, exiting their GP positions and not wanting to pay a bunch of tax, exiting their crypto and wanting to start a business venture, building investment real estate. The Deferred Sales Trust unlocks that once you understand it.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Brett Swarts is the founder of Capital Gains Tax Solutions. Each year, he equips hundreds of business professionals with the Deferred Sales Trust tool to help their high net worth clients solve capital gains tax deferral limitations. Brett, that's a mouthful. I know you've come on on a previous episode. I think this was last July 21st, episode 234, that you came on where we really dove deep into the Deferred Sales Trust. So if you're listening and going, hey, I don't even know what that is, hit pause, go back and listen to that episode, again, 234 on July 21st of last year, 2021. Get an understanding of that, because we're going to kind of take a different spin on this today. Brett, welcome to the show.
Sam, great to be back. Excited to add some value to you and your listeners.
Hey, man, absolutely excited to have you. One of the things that you and I spoke about here recently, we were both at the Best Ever conference, and we really started digging into the crypto/real estate conversation. And that's really what I'd love to spend the bulk of this episode talking about. Tell us, can you kind of just, the floor is yours. Take over wherever you want, but that's what I want to talk about. Tell us what you guys are doing in that space and really why and what need you're solving or what problem you're solving.
Absolutely. So, most crypto millionaires, they struggle with their capital gains tax when they go to exit their highly appreciated positions. In fact, a recent study was done. There's about $2 to $3 trillion, depending on the the year that you're looking at these numbers, of cryptocurrency in the world. And these are highly appreciated assets. Talking thousands and thousands of percent returns. And so when they go to exit, they have a huge capital gains tax. And so we believe the opportunity to defer that tax and to be able to diversify that wealth is one of the best ways for crypto millionaires to create and preserve more wealth. And with that, connecting with the apartment syndication world and or commercial real estate syndication world is complements this whole strategy of what I'm calling tax flow versus cash flow.
Can you break that down? What do you mean when you say tax flow versus cash flow?
Yeah, so most of the time we were told, and we're told all the time, Robert Kiyosaki and all of us who love multifamily investment real estate, it's cash flow, cash flow, cash flow. But I'm here to tell you it's not just cash flow, it's tax flow. And now, of course, it's always been both, but more and more important today because of the highly, let's say, accumulating debt in America, especially over $30 trillion, that the government is running out of options except for to raise taxes. And that is a big problem. And so it's more important as we, as entrepreneurs, as business owners, as cryptocurrency and multifamily investors, that we look at our tax flow strategy and not just the cash flow. Because let's face it, the most expensive things that we're ever going to pay in life, one of them is taxes, if not the most. That's the one you're paying the most out of anything, anywhere. And so you've got to figure out ways using the regulatory framework to have tax efficient cash flow, not just highly appreciated assets.
Right. Yeah. Because what good does it do you to have a highly appreciated asset that you're paying a ton of taxes on? And I know you've kind of specialized or found a way to do this with the Deferred Sales Trust. How are you doing that with crypto? I'm just going to use the word crypto millionaires. How are you doing it with crypto investors that have made a whole bunch of money?
Yeah, well, we'll start with the story of August 7th, 2021. And that's the moment we broke the 4-minute mile. I don't know if you saw that Roger Bannister story about the person who broke 3 minutes and 59 seconds. He broke what many thought was impossible to break. Well, for us, that happened on August 7th, 2021 for a client of ours who owned Ethereum. He and his wife bought it for about $100,000 and went to $13 million. And they're living the 50, 60-hour work week in the tech industry. And she's an attorney and 2 kids. And they are, making a good salary, but they're living in California and it's very expensive. And they're looking at this huge, huge amount of appreciation. And they're looking at exiting but paying millions of dollars of tax. And so for the first time ever, we helped them exit out of crypto, all tax deferred, and anyone for the deferred sales trust for that matter, over 25-year track record, the deferred sales trust been around, and they were able to retire from their day-to-day job, travel with their family, and then invested into, in this scenario, they've invested into securities at this point, but they're waiting for the real estate market to shift, and they're looking for opportunities to buy that. And so that's what we're providing here, an opportunity to exit, get some freedom, get some cash flow, get some tax flow, and also defer millions of dollars of tax. So they did a $5 million deal, and then we deferred about $1.85 million of tax. Then they liked it so much, about 3 months later, Ethereum hit another high for what they were looking for. They exit $2.5 million, and that's within 1 hour each. And that's the beauty of what we provide. It's so fast, so instantaneous, but it's a huge impact for the families that we're serving.
Yeah, that's really interesting. Is there, while we're on this topic, are there any assets that you can't put into a deferred sales trust?
No, it works for just about anything you can think of. It works for artwork, collectibles, public or private stock. We've done it for apartment complexes, self-storage facilities. We've done it for a dentist. I just did a dentist deal for a client out of New Jersey that was looking at a huge tax. We helped them defer $600,000 of tax on about a $1.5 million exit. It works for primary homes, luxury primary homes, as opposed to the 1031 exchange, which only works for investment property, or even the Delaware 1031 that only works for investment property. So the deferred sales trust really has zero limits on what it can defer. Captive insurance, it can work for general partnership interest, LLCs, LPs, anything you can think of. Now, here's the key. It needs to have a $1 million net proceeds and a $1 million gain. It's got to be big enough in order to hire us, right, to pay for the services that we provide.
Right. Yeah. I mean, that makes a heck of a lot of sense. You said 1 million net proceeds / $1 million net gain. That makes a lot of sense. That's really intriguing. How did you figure out, or how did you find clients that have made money in crypto and say, hey guys, let's all put this into a deferred sales trust?
It's a great question. We started talking about it. Right. We start talking about the challenges that many of the crypto millionaires are facing. Right. We actually started investing in ourselves, in cryptocurrency. I started investing in 2017. My wife and I, we buy these, we call them Ethereum rigs. They're these supercomputers that we put together with our kids, and we talk about Robert Kiyosaki's cash flow and get it on the right side of the quadrant. And we say, like, these are little cash flow producing machines. As we sleep, they are producing some cash flow, Ethereum, right? We also want to buy rentals. And so it's a part of immersing ourselves into that world, and then trying to feel some of their pain, right? Because all of us had friends or family who invested and went high and maybe went low or lost everything. And we're going, there's got to be a better way. And that's the same story that happened with apartment complex owners in Sacramento when I was at Marcus and Millichap. Same exact thing happened in 2008. And part of it was that 1031 exchange chasing that deal and deferring that tax, but doing it in a way that put them in a poor position financially because they had too much debt, not enough liquidity. And so we focus like a laser on what's called optimal timing, sell high and buy low. And we just apply that to the crypto millionaire space. And we started a mastermind. We started podcasting about it. And now everyone's finding us mostly on YouTube and podcast.
Right. No, that's really, really, that's interesting for sure. So inside the deferred sales trust, just so I can make sure I understand this, it is not time bound like a 1031.
Exactly. So the deferred sales trust is amazing in that it's not time bound like a 1031 exchange. We call the 1031 exchange 45-day, 180 time frame, the shotgun wedding. We all had friends, maybe a family who got married really quickly, right? And sometimes those things don't work out. And so the idea of optimal timing is being able to sell when you have a certainty of conviction that it's a good time to sell, exit that position, and then be on the sidelines and be ready to pounce onto opportunities, whether that be real estate, whether that be securities, whether that be back into cryptocurrency, whether that be into hard money lending, all tax deferred using the deferred sales trust. So I'll give you another example. We just helped a client. She bought Bitcoin for about $50,000, and she's working for a big tech company in Silicon Valley. And she had her $50,000 investment turned to $50 million. And I get this call and I'm going, oh my goodness, like, you have a huge gain. She's like, yeah, I never sold. And I go, why have you sold? She goes, part of it because of the tax. I'm in California. I'm going to get hammered. Part of it, I believe in the long-term future of Bitcoin. But the third part is I don't have a great place to invest it. Like, I don't necessarily trust a lot of different things. She goes, she goes, I'd like to invest in this business venture. Can I go into real estate or another business venture with this? And I said, using the deferred sales trust. And I go, yes, absolutely. So she exited the first $5 million when Bitcoin hit 54,000 a coin. and she deferred about 1.85 million of tax. And she's invested into a startup company. For her, the freedom was she could retire from the big tech company, but she could also build another company with her college roommate. It's an educational platform. And so what we like to say is we're unlocking that freedom. Like Robert Kiyosaki on the right side of the quadrant, right? Getting on the business or investment side of things. It's like, how do we use tax flow in this situation using the deferred sales trust to unlock what someone's really trying to accomplish, whether that be moving, closer to family, selling that big primary home, exiting their GP positions and not wanting to pay a bunch of tax, exiting their crypto and wanting to start a business venture, building investment real estate. The deferred sales trust unlocks that once you understand it.
That is awesome. I love that. That's really cool. Talk to us. And I know we probably dug into this a little bit, but on the previous episode, but just these questions are coming up in my mind. Much like, let's say you're a self-directed IRA investor, all the proceeds have to go back into the IRA. Is that the same story with a deferred sales trust, where even though maybe you're deferring tax and things like that, you still really can't access the money? Or what does that look like as income producing real estate throws off cash? Where does that cash then go?
Yeah. How is the deferred sales trust like a self-directed IRA, and how is it not? Well, first of all, it's like a self-directed IRA is that when the funds are in there, it's in a tax deferred state, and the growth in the cash flow can typically grow tax deferred. Why? Because it's able to expense what it owes to you in a given year, even if you haven't received payments out, right? And that's a really cool thing. So it's growing income tax deferred and capital gains tax deferred. It's unlike a self-directed IRA, and there's no required minimum distributions, although we do recommend and how we structure our promissory notes. And for those who are wondering, the deferred sales trust, you're lending the funds to the trust in exchange for a promissory note, and the trust is paying you back over time. We do like to see some payments coming out within the first 2 years, some amount of payments coming out where you will pay some income tax on. Right. But there's no other things as far as if you're partnering with the trust, you can partner with the trust and you can buy investment real estate. And the way we structure it, you can you're an owner of an LLC, and you can partner with the trust where you can get the traditional cash flow and that's depreciation. And not all of the cash flow has to roll back into it. And so it's much more flexible, Sam, for sure.
Can you keep all of the funds inside the trust and leave it there if you want, or if you want, can you also take money out? And it sounds like if you take money outside of the deferred sales trust, it just becomes taxable ordinary income.
Yeah, let's define taking out. What is a taxable event with the deferred sales trust? Yeah. The answer is if you take it personally into your personal account, or you use it and you spend it on like a primary home or your personal expenses, right? So the government gives us these tax deferral options in order to incentivize us to do the things that they can't do very well. It's part of why they encourage us to build and manage and own multifamily properties, because they're not very good at being in the housing business, right? So they give this depreciation. This is back to the tax flow concept here, right? So the deferred sales trust, likewise, based upon IRC 453, which is an installment sale, it goes back to the 1920s, they're giving us this tool to incentivize someone to exit cryptocurrency or another business. And as long as those funds are put back into the economy, i.e. business ventures, investments, which is going to spur economic growth, which is what? Going to spur job creation, which is going to what? Spur income tax, right? So they're winning here, we're winning, and that's really the goal. Like, where are the funds going and how are they taxed? So let's play that out. If you partner with the trust and buy investment real estate and build that for a client, I just did that for a $2.6 million business sale in Tennessee, and he's building 72 multifamily units in partnership with the trust. You're doing it in a specific order. It's all of that's tax deferred. Okay. But the moment he wanted to put into a primary home, should he do that or take it personally, then it's taxable. Does that make sense, Sam?
Yeah, 100%. That answers the question, the question entirely.
If you want to talk about depreciation, maybe that's what you were thinking, right? So when you start to partner with the trust, you can build or buy multifamily properties, and then you can do some cost segregation on those. And like this is a cool tax flow ninja trick. Yes. And that you take something that was not depreciable, like cryptocurrency or a public stock or private stock, or something that was fully depreciated. You exit it and you use the tax flow situation to partner with the trust to buy or invest in new investment real estate. And guess what? It's new money and it's not 1031 money. You get a new depreciation schedule. And to the extent that you're an active owner, you get some depreciation to offset a lot of that cash flow, which is pretty cool, right? You don't get the full amount of that depreciation. You'll get a percentage of that. But these are all the cool things that we show you how to do, right? Because again, it's not just about cash flow. It's about tax flow. How much are you going to net after taxes if you have some depreciation to offset?
Talk to me about timing on this. I mean, I think if everybody knew the capacity or the capabilities of a deferred sales trust, it would be a very different environment for a lot of business owners, for a lot of people exiting things, especially on the real estate side. We see a lot of owner financing, especially on smaller deals, anything sub 10 million. If it's a mom and pop owner, most of the time they'll want to do a seller carryback just so they're not getting hammered with taxes all in one year. But this would be a unique strategy, of course, where they could plug it into deferred sales trust. But where in this process does someone have to come to someone like you and say, hey, I need to employ your services? Is there a wrong time to do it?
Yeah. When is it too late for the deferred sales trust? It's too late if the buyer has removed all contingencies. And that means there's nothing remaining, and that's what's called constructive or actual, like we're closing in a couple days or a week, and there's nothing remaining between basically you and the seller being able to force the sale. They can say, you must transact, Mr. Buyer, and because there's no contingencies remaining. That is when it's too late, unless you're an investment real estate property owner and you can send the funds to a qualified intermediary, and then we can save a failing 1031 exchange on day 45 or day 181. These are the things that we work through with people all the time. In fact, we have an entire system, and I would highly encourage you to never use a company that will not allow you to use a deferred sales trust. Make sure your accommodator is willing to accommodate, and we have those, but I literally have had 2 or 3 calls, millions of dollars on the line for a very, very large exchange accommodator that is not allowing and will not move the exchange. And they're putting these people in a terrible position, and they'll never use them again. And so you got to be very cautious. 1031 exchange companies don't want you to know about this. Most of them don't. Your 1031 exchange broker or commercial broker, most of them don't want you to know about this. By the way, I'm a commercial real estate broker, started at Marcus and Millichap. I love 1031 exchanges, but I love options more than that, and letting my clients make the options for them, what's best for them. So you got to be very, very educated and prepared and have the team ready to go. Okay, so that's the timing aspect. Now, everything else that's not 1031 eligible, we've got to do it before the buyer removes all contingencies or before you have exited your cryptocurrency to cash. Even if you have Ethereum or Bitcoin or a different coin and you're moving those coins. Remember, if you move from coin to a different coin, it's taxable, right? So to set up a deferred sales trust for a cryptocurrency owner, what we do is step 1, we set up a trust. Step 2, we open up the trust account at a place called Kraken is one of them that we use. It's like a Coinbase. Step 3, you transfer the coin to the Kraken account in the name of the trust, right? So you haven't transferred it to your own name. It's the trust account. You get in exchange a promissory note. And from there, the Kraken trust account can sell to cash, and then it can go to a bank account, and then it can start paying you. So these are all the steps that we help guide you through every step of the way. So hopefully that answers the question, Sam.
Yeah, absolutely. I mean, that's it. Is when is it too late? That's the summary question. Because I'm certain people have come to you in the past, and you're like, "Hey, I'm sorry, you're too late," and that's got to be a really disappointing conversation. Is there any golden parachute at that point somebody can pull out that's different than a deferred sales trust?
There's an opportunity zone if it's within 180 days from the time they closed, right? And so opportunity zones are one of our good cousins that we like here at Capital Gains Tax Solutions. They're like the trusted cousin. And by the way, the 1031 exchange is a trusted cousin too. If you could find the deal, it makes sense. So you have Delaware 1031s, which we use for mortgage over basis. The cool thing, for Capital Gains Tax Solutions, for a plug for us, is we're agnostic as long as the thing is absolutely the best fit for you. Right. And it's helping you clarify that. So we're called Capital Gains Tax Solutions, plural, and we're going to assess. And sometimes it's a mixture of both. Like I'm closing a deal in Colorado. It's a $4.5 million deal. And this particular client has what's called a mortgage over basis. And we're using a partial Delaware statutory trust to extinguish and or replace some of that debt over basis. Because the deferred sales trust cannot replace mortgage over basis, cannot defer that. So we got to replace that debt. We have a unique zero Amazon coupon deal where they're able to put a partial amount into that small amount of equity, get a huge amount of debt replacement, non-recourse out of their name, and then the rest of it can go into the deferred sales trust. Where guess what? This client wants to get into some cryptocurrency, and he's been an apartment complex owner and syndicator for years, and he's looking to diversify a little bit because he's not seeing enough yield in some of these apartment deals that he would like to see. And so that's the cool thing about what we provide. And the key is which options or options plural is best suited for you.
That's really awesome. It just sounds like there's so many tools in the toolbox. that you guys have to help out people who are facing a tax liability situation. And I think that's the summary of the show, is that even if you're in crypto, if you're in business, and again, we're a little bit of a rerun of the first episode, but it doesn't matter what you're in, that there are ways to reduce or eliminate your entire, largest liability, which is your taxes.
Can I add one more to that too, by the way? So we're called Capital Gains Tax Solutions, but we're also estate tax solutions. Okay. And so I want to give you guys a little extra bonus here. So we had a client, they were selling a $5 million asset in Colorado. This is a different client. They're selling an apartment complex. This is about 2 years ago, and they were $25 million. And their challenge wasn't just capital gains tax, although they had a zero basis and they had a lot of gain there. Their challenge was estate tax, and that's 40% of anything above basically 22 million married, Sam, or 12 million single. And it has nothing to do with the stepped up basis. The 1031 exchange does not solve this. The swap until you drop does not solve this. You have to get the funds, the equity, the assets outside of your taxable estate. So generally speaking, most folks are either buying a bunch of life insurance, they're doing a bunch of gifting to their kids as fast as they can, or they're giving it all away to charity as much as they can, right? Well, guess what we provide? Without having to do any of those first three, they exited their asset into what's called the Deferred Sales Trust 2.0. It's the DST Plus is what it's known as. And they completely eliminated that $5 million outside of their taxable estate. Now, they're still pretty young. They're late 50s, early 60s, and they're looking at growth on this $25 million estate to probably 50, potentially 75 million. Well, guess what they just did with 5 million of that? They exited outside the taxable estate, which is what? It eliminates 40% of the death tax. Okay, so that is huge. So for anyone who has ultra high net worth clients and is looking for an elegant solution upon an exit of an asset, the Deferred Sales Trust Plus has got to be one of the things that you're looking at, because it's amazing at what it can do.
That's awesome. Brett, again, I've certainly enjoyed it. Thank you for coming on today. This was a blast to learn yet again all the really cool things that you can do with the Deferred Sales Trust and the other options that are certainly out there. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
There's a couple options. Number one, go to capitalgainstaxsolutions.com or search that on Instagram, Facebook, LinkedIn, and YouTube. YouTube is our big place where we provide a ton of free content. We have a ton of playlists, how to save a failed 1031 exchange, the 1031 exchange versus the Deferred Sales Trust, the Deferred Sales Trust versus the Delaware Statutory Trust. And then we have our cryptocurrency series as well, where we break down how to do this step by step. And then we have our mastermind every Friday at 10 a.m. Pacific Standard Time, 1 p.m. Eastern. It's the Crypto DST Mastermind. We bring on clients. We bring on people learning about it for the first time. We bring on experts to talk about all of these things. And it's like a classroom. We're all hanging out. I'm on there. My team members are on there. My strategic alliances are on there. And we're just talking all about these types of things and frequently asked questions. And the last thing is we have expert tax secrets. And where's my book? I'm coming out with my book. It's in the other room. We're coming out with a brand new book. Kevin Harrington's going to be in the book, which is pretty cool. He's from Shark Tank and a bunch of other people. And so you can check out that new book. It's called Building a Tax-Deferred Exit Strategy.
Love it. Brett, thank you again for your time. Have a great rest of your day.
Thanks, Sam.